Good afternoon, ladies and gentlemen. Welcome to Market Today on Business Today Television. We have our special guest today in our special episode of Market Masters. Mr. Aashish Somaiyaa is the Executive Director and Chief Executive Officer at WhiteOak Capital and a veteran of many a bull and a bear market. Namaste Aashish ji and a very warm welcome to you. Belated happy birthday.
Thank you. Thank you very much. Thank you for inviting me.
Okay. Ladies and gentlemen, the reason to get Aashish ji on the show is very simple. As I have said in my opening commentary, Aashish is a veteran of many bull and bear markets. He deploys about 27,000 crore rupees in Indian equities, spread 17,000 crore rupees on mutual funds and 10,000 crore rupees on AIF and PMS schemes. So he is a thoroughbred when it comes to picking stocks which create value in the long term and also navigate the current bear market that we are in. Aashish ji, my first question to you is, at this point, do you think that the worst is behind us after a 6-month correction on the Nifty, the Bank Nifty and many other sectoral and large indices?
I think I wouldn't say the worst is behind us. The reason why I'm saying is because if you see just now in the last few days, we have seen another leg of headwind coming because now the US market itself has started to correct significantly. I mean, multiple GDP downgrades in US, multiple concerns about the fallout of Mr. Trump's actions, and multiple questions on, up the AI, nobody's calling it a bubble, but at least people have started using the word hype. And when the results of Google, Amazon, Microsoft kind of companies are coming, people are definitely questioning what will be the result of all this AI investment, right? So I think that, bulk of the correction is done. But till now we were correcting because most emerging markets were correcting. Strong dollar, rally in US, Trump trade, multiple things happening. So all emerging markets were witnessing currency depreciation, outflows, US outperformance versus emerging market. We were part of that. And now you are suddenly seeing that there's another downdraft because US also. So I think we're in the final leg of the correction, but I don't know whether it is next 15 days or next 1 month. Close to bottom, but I can't say the worst is behind us. At any level, another 5-7% we can't do that.
Fair point. It's catching the bottom is mostly an academic exercise that happens in hindsight, and those who do catch the bottom are either outright liars or have a good, how should I say, thought process about themselves. Be that as it may. Aashish ji, given the fact that a lot of people have lost, technically lost a lot of money in this downturn because of how valuations have eroded and how stock prices have collapsed, what is your own learning in this episode that has is still ongoing with us over the last 6 months, and what is your advice to investors?
My learning is 2 or 3 things. One is actually, see, kya hai ki in the last, say, 4 or 5 years, first it started with demonetization and then accelerated with COVID because these are the two instances when digitization took a real fillip. And the biggest manifestation of digitization success is the capital market, where a lot of, and it has coincided with our demographics and, the overall
Yes.
things. Now, equity investing has really caught pace in last 4 or 5 years.
Yes.
And everybody has a different journey. Somebody come through mutual funds, somebody come through FNO trading, somebody may be buying stocks. Now, what has happened is, if you take the index Nifty or Nifty 500, they are down 15% and 18% respectively. You take small cap, mid cap 20-25% down. You take average mutual fund 15 to 20% down. But if you take individual stocks, see what happens unless you are a deep researcher or you are a contrarian at heart. When you're doing direct investing, what ends up in your portfolio is all the hot things of the last 3-4 years, which is basically all the PSU, railway, defense, infrastructure and all. People who are directly investing on their own, they are not preparing a portfolio with a benchmark or an investment universe in mind. They are just buying what is being spoken about or what is so-called hot in the market. So I think that the destruction in direct equity portfolios is probably 2x of what is in mutual fund NAVs. So one, you take it with a pinch of salt. You expect me to say that, but I think, portfolio construction is not stock picking. Stock picking is just a subset. Actually, constructing a portfolio which can weather the markets and outperform the market, I think, is a completely different ballgame which people need to take cognizance.
I think that's a very, very sensible advice that buying stocks at random and those especially in the hot sectors at any given point of time versus constructing an all-weather portfolio are two different ball games with diametrically opposite results, as is evident in the next 1 or 2 months that are also with us. So, Ashish ji, how have you spent your time over the last 2 or 3 months deploying fresh cash that is coming into the market for your mutual fund investors? What has been your pick, and what about PMS and AIF? Have you tread differently for them because they are, how should I say, a little more intelligent investors compared with mutual fund retailers? How has your approach been different for both of them?
So, Shailji, actually, there is no definition of intelligent when it comes to our market. Whoever thinks it is intelligent, market's job in life is to challenge all of those people. And sometimes intelligent people are actually the people who just keep the faith and keep going. And in hindsight, people who do a lot don't end up being really intelligent. So I would really not classify as retail versus HNI or intelligent or institutional or anything like that. I think it's just the long-term investors who end up benefiting. But coming to your question, really, in the last few months, see, there are 4 or 5 things I have been telling everybody. Uh, One is that we have consistently been telling people not to be very aggressive, but to stagger their investment. Even now, like I answered your opening question, even now I have been telling people that stagger for 3 months. So right from July, August last year till now, I have always been telling people that please stagger the investment, please don't be aggressive. Previously we used to say that stagger for a long time. Now we are saying just stagger for next 2, 3 months. But still, the advice is not to be aggressive. The second thing, what we've been telling everybody is that wherever people are conservative, it is better that they are in a mix of gold, equity, and debt, and not just equity. Because like we do this multi-asset, or some, if you know the industry, 20-25% of active industries in these hybrid funds like balance advantage. So
Yes.
this helps. Either you stagger your investment or you be in a hybrid fund. Whatever you do, you take exposure to equity in a calibrated and gradual fashion. That is the second thing. The third thing which I have been telling people related to that direct equity conversation we had. See, I have found that generally there is a tendency in the last 3-4 years, whatever is cyclical, policy driven, macro driven, the whole PSU, railway, defense, infra, energy, utility, these things have given very handsome returns to people. And now in the fall, these are the things which are 30-40% down. Individual stocks may be 50-60% down. Now, I always found that there is a tendency amongst people that where they made money in the past and where it has fallen a lot, that is where people keep on tending to average, average, and average. So just imagine what would have happened if you kept averaging IT stocks in 2000, 2001 and 2002. What would have happened if you kept on averaging infra stocks in 2007, 8, 9, and 10? So same way today, people are keeping on probably thinking of averaging all this defense and PSU and all. I'm not saying they are bad. It's just that the prices may have already reflected. So my learning is that if the market were to recover, what has fallen less or what has underperformed in the falling market, that is more likely to outperform going forward. So, not to average your past winners. I think this is something also which we have been iterating. And the last thing we've been iterating is not to read too much into micro analysis of why FIs are selling and why the market is policy. I have seen that every year or 2 years the reasons are different, but every year or 2 years market falls 15-20% from the top, and every 2-3 years market makes a new high. FIs are not waking up in the morning thinking that India is bad, let us exit India. In fact, India is a rank outperformer. Last 3-4 years, emerging markets have been underperforming. वो तो हम बच गए थे. We were an outperformer. We are participating in the emerging market downdraft only in the last 3-4 months. Otherwise, we were a solid outperformer. Our currency, our market, we outperformed in a big way. Otherwise, US, in front of US, all emerging markets have been underperforming now for quite a longish period. So not to do this micro analysis, we cannot identify to the last point that, okay, this is the reason why there is selling. A lot of times the reasons are beyond us. It's a very large global dynamic market.
जी.
So I think that, just be slightly contrarian in our approach. And on a lighter note, I always ask people, I travel a lot, I meet a lot of investment advisors, distributors, and clients. Everybody keeps saying be greedy when others are fearful, be fearful when others are greedy. I always tell them, step back for a moment and think, who is the others? The others is all of us. So, we have to be a little contrarian, and that will help us to make some money.
Okay, wonderful thoughts here, but let me just pick your brains further on those stocks who have underperformed this fall, which essentially means they have dropped less than what the index, whatever the benchmark index is within the large caps, within the small caps, and within the mid caps. So, Ashish ji, I am sure this is an area where your research team has also worked super hard and added fresh positions into such underperformers which have dropped less than the market. Now, could you please share with us over the last 1 or 2 months what these sectors are and where has fresh money been allocated?
Yeah, so see, when the market was booming, what was booming was everything which was cyclical and policy driven and PSU driven. And what was underperforming was, see, not necessarily in earnings terms, but purely in terms of price performance or because of over in ownership or a time correction. What was underperforming clearly was the financials, especially private sector financials, right? Even if you take NBFCs, if you take lenders of all types, you take insurance, all of that. So that was consistently underperforming. Then if you see, for example, uh, say IT and digital, or say, for example, healthcare, say chemicals. So a lot of these things were consistently underperforming in last 3 4 years. Now, when the market has fallen, the stuff which really performed a lot, that is down 30-40%. And all
Yes.
these other things which I mentioned, like the banks, etc., they have not fallen. I mean, they have fallen much lesser. They've probably fallen single digit when everything else is down 30-40%. So I was just trying to say that, if the market were to recover, a minimal amount of delta buying will cause these things to actually outperform first, the stuff which is not. So on your question, I think what people should be really looking to allocate, or where we would be overweight, where people should look at, is say all the private sector financials across the spectrum. I mean, not just the big banks, even say, for example, NBFCs, even capital market entities. Like I always say, for example, capital market entity stocks are down 50-50%. Now, I have not seen them being as cyclical as the market actually tries to portray it to be. Then, for example, if you see, in the recent past, because of this AI, all the IT stocks are getting hammered or
Yes.
getting. But I feel that it's not that much of a dire prognosis as is being made out. In the last 7 to 8 years, there are multiple times these kind of obituaries written about big IT. For every occasion it is written. But I think that it's getting overdone. So these are the areas. Then say, for example, healthcare. Again, worries about US, etc. But it was after COVID, it was consistently underperforming, and in this fall, it has actually outperformed now. So these are, I mean, these are maybe slightly contrarian kind of things which people were not looking at in the last few months.
Wonderful. So, we have benchmark themes, which is private sector financials, including NBFCs, a smattering of insurance, and maybe the capital market segment, which we are so keenly involved with, parts of IT, parts of healthcare pharma space. Ashiji, one more point I'd like to understand. There is a broader consensus in the market that large caps are likely to outperform over the next 6 to 8 months compared with mid caps and small caps. This is the broad understanding that we have, because valuations were out of whack in mids and smalls. Now, in the 4 or 5 segments that you have mentioned, are you hunting for large caps in this space, or are you hunting for growth?
So, a couple of things further, like, when I was mentioning, say, everything to do with, say, discretionary consumption or high-end consumption, like, travel, tourism, hotels, or say white goods. I mean, white goods, obviously prices had run up and then they corrected, but one has to look at it selectively. And the last thing, when you were saying, say, large cap, small cap, mid cap, if I take the pecking order in our portfolios, let's say you take a flexi cap or a multi cap fund and you take the pecking of the market caps, what you're likely to find is that the top is large cap, then small cap, and then mid cap. So our exposure in that descending order in any mixed market cap product is that the top allocation is large cap. Say you take our flexi cap fund, it's about 60-65% large cap, 24 to 25% small cap, and then 10 to 15% in mid cap. That's the pecking order. The reason is like this, that if you see, for example, when I mentioned financials, IT, healthcare, discretionary consumption, a lot of this tends to be large capish in nature, right? But when I mentioned, say, white goods or some other parts of discretionary consumption, that could be small cap or mid cap also. Healthcare, it could be small cap, mid cap. The second thing is that if you see, there are significant amounts of, say nowadays manufacturing, the smallest of companies who are seeing that their business is seeing transformation either because of export or because of import replacement or whichever way you look at it. So there are consistently new ideas coming. So we are not, see, small cap is a space which is very, very volatile. That is well appreciated. Once in every 5 years, it falls 30-40%. That is well appreciated. But that is also the happy hunting ground for people like us, for alpha generation and for new ideation. We are living in a market where, food products like, say, bhujia, potato wafer, like I said, so many new companies are getting listed, have got listed, will get listed. So, while the small cap index has been really volatile, but stock picking and ideation continues.
Fair point. And I think small caps over the last 20-25 years have been the biggest wealth creators in the market, as also they have also given the biggest scares. So if you have a strong heart where you can sort of overcome this volatility by sensibly remaining invested in the downturn, then probably small caps are for you. Ashiji, I'd also like to touch upon the most recent controversy that's happening in our world of mutual funds, where there are some views that this rally was fed because there were excessive SIPs, systematic investment plans, coming into mid and small cap funds. What is your view? You've consistently maintained that SIPs have created immense wealth. Where do you stand in this debate?
So, it's a very nuanced thing. I want to clarify a couple of points to you. So, it is also related to your previous question that where are we deploying money? Now, two things to tell you. In my entire, learning or whatever journey I have had, I have seen that small cap is very volatile. And, that much volatility, but if you take 15-year, 20-year CAGR, what you will also surprisingly find that the small cap index till recently was just 1 or 2% ahead of large cap index on a 15-20 year basis. Now, the small cap return versus large cap over 15-20 year, both the indices, the return might be actually similar. So over a long period of time, the small cap index has actually not really outperformed large cap index. But still, I mentioned that small cap is a happy hunting ground for alpha creators because that is the space where new companies come in. That is the space where new ideas come, and that is where a lot of alpha generation happens. And also, it is a space which is full of heterogeneity. See, large cap mein, what happens is that there is, big IT companies, big banks, energy, oil, utilities. There is limited heterogeneity to generate alpha in large cap. The maximum alpha can be generated in small cap because of heterogeneity, wider number of sectors, less institutionalization, more scope for research, etc., etc. So these are the reasons why we are fan of investing in small cap. Now coming to the mutual funds and the SIPs. So, managing the market cycle, the high volatility of small cap. And let me exemplify what I mean by high volatility of small cap. Jan 2018 was a peak. By April 2020, it fell 66%. From April 2020 till October 2021, 4x the small cap index multiplied. From October 2021, it started falling. In March 2023, it went back almost to the same level as Jan 2018. And then again in 2024, it made a peak, and now again we are down 25%. So the volatility is very high. In fact, that is the reason why we don't have an open-ended small cap fund. But right now, as we speak, we are raising money in a small cap AIF because it will be close-ended and it will not expose people to behavioral vagaries or to peaks and troughs of the market. So we are advocates of investing in small cap because we can generate alpha. But at the same time, we know that when you manage an open-ended small cap fund, the propensity is that money will come in 2018. People who stick to the SIP are definitely going to make money. But people who come at the peak and lose patience, the market falls 20-25%. That's a recipe for disaster. They are the ones who will not make money.
So
As an
essentially,
asset manager, yeah.
please continue. Please continue.
So as an asset management company, we should talk about how our liability side is, either take money only through SIP, STP, or run it in a close-ended format. But after the money comes and the market starts falling, if we all start getting worried and scared, that doesn't help anybody's cause.
My final question to you, Aashish ji, is 2025 a write-off year after a very, very strong 9-year performance by the Nifty and huge participation on the retail side, as also the Ultra HNI, as also family offices, as also newer and better AMCs such as yours? Is this a crowded trade as far as the Indian markets are concerned, and where do you see the Nifty in December 2025?
So, see, considering that, like I said, every year, once the market falls 15% from its peak, I am very happy in a year where it happens in the first couple of months itself. You might recall 2023.
Ji.
In 2023, 2022, we closed with 19,000 kind of number. By March 2023, we had Silicon Valley Bank, blah, blah, and we were down to 16,600 Nifty. Of course, that time people were talking Third World War and stuff. The forecasts were even more dire at that time. Now we are in 2025, and the year has started. First couple of months we are down 15-16%. So, and like I said, it may get worse before it gets better. I don't know about December 2025, but say anywhere between December 2025 to March 2026. Let's say you give me a little bit leeway. You talk 1 year from now. My sense is we'll be in a better position. Because a lot of our headwind, like I said right at the onset, a lot of our headwind is related to US. I have seen in the past, whenever we get a big downdraft because of FI selling, because of global reasons, and our market falls double digit, 12 to 18 months from that bottom, generally you find that very good returns are made. Foreigners selling in India because of global reasons is not something for us to get scared about, because they are not selling necessarily to do with India. Yes, from time to time markets become expensive, then markets become cheap. That is part of the cycle. But I don't think there is fundamentally anything which has gone wrong with us. And if we are getting a big correction because of external reasons, largely speaking, in hindsight we can always debate कि हमारा valuation ज़्यादा था, etc., etc. I'm not debating that. The limited point is that if we get such a big correction for external reasons because of FI selling, somewhere in the next month or two, it will play out, and a year from now we'll be in a much better position. I think people should look to participate in the next 2 months.
Fair point. Ashiji, with that lovely understanding of the market and of course pointers that you've made towards where WhiteOak's fresh money is going in, thank you so much for your time, and again have a great birthday party over this weekend, and let's hope that the worst is behind us.
Thank you very much. Thank you for calling me.
That, ladies and gentlemen, was Mr. Aashish Somaiyaa, Executive Director and CEO of WhiteOak Capital, where fresh money is getting deployed into financials, the private sector, which includes NBFCs, a bit of insurance, some healthcare, some chemicals, as also in the capital market space. I hope you enjoyed this conversation as much as I did. Please continue watching Business News Television. There's a lot that's happening on the other side of this break. Thank you.